Hey, Tyler Crow, did you know, I'm guessing you do, that the average holding period for a US stock investor is less than 1 year? It's like 10 months or less.
Do you know how much that breaks my heart, Jason? So not only are people not enjoying the long-term benefits of stock ownership, they're paying income tax rates instead of capital gains rates.
Higher taxes, spending more time chasing ideas. It's crazy because all of the data is overwhelming. And we've had tons of great examples like Peter Lynch and Warren Buffett and others who have demonstrated that the greatest way to create wealth through the stock market is actually the simplest. And that's just to buy great companies and hold them for as long as you can. That buy and hold, own forever approach, as close to forever as you can get anyway. So, Tyler, let's share some of our favorite buy and hold stocks that investors can buy right now to create wealth for themselves and their family.
Let's do this.
I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Again, that's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Check out that link. Tyler, I want you to go first. And I think there's a little bit of kind of fun irony in the stock that you're going to talk about. It's a company that people use to store stuff that they don't really need, and they're paying good money to store stuff that they don't want. They store this stuff forever. It's a company that benefits from that, and investors can benefit from it too.
Yeah, hang on to tchotchkes for decades, but don't hold on to your stocks for more than 6 months. That's an apt description here. The company I want to talk about is called Public Storage. They are a real estate investment trust that specializes in storage units.
Tyler, I want to share one chart. We led with long-term buy and hold. I want to share one chart here before we start this off. If people are yawning or bored with the idea of public storage, but you like the idea of buy and hold for the long term, this is since Public Storage went public. It's the purple line here versus the S&P 500. The S&P 500 up about 2,800% since the late 1980s. Public storage stock is up 10,000%. That's a whole lot of bags. And I want to annualize that. The market generally can generate those around 10% annualized returns. They get 10.3% for the S&P over that period, 14.4% annualized returns for public storage over that period. That is massive excess returns for the patient investor owning the high quality business.
It's not exactly the most glamorous business, but I think most of the time when I talk about businesses, they aren't glamorous. But what is so impressive about storage real estate is almost how bad you can be at this business and still make money.
Still make money. Absolutely.
I can't remember if it was Public Storage or one of their competitors, either Extra Space Storage, CubeSmart. There's a few self-storage REITs out there, but one of them I believe, on a conference call, they said at 30% occupancy, we break even. So 70% of its units can just sit there idle, empty, do nothing, and they will break even. That just the economics of this business just bewilder me on how lucrative it is.
Most REITs, publicly traded REITs, have to have 90% plus occupancy to generate excess cash flow. So that should show you how lucrative this business is. Why public storage now? What compels you about the business today? Why do you think it's worth buying right now?
So this is it's a little bit macroeconomics, a little kind of big picture stuff. I do believe that with interest rates higher and that we are likely going to stay in higher interest rate for some time, I want to look for businesses in these kind of industries with better debt profiles and the ability to strike when the iron gets hot. I think there's going to be a lot of real estate developers, real estate sponsors, people out there in various parts of real estate that are not going to be in a very good situation when they have to refinance debt over the next couple of years. And when that happens, well-financed, low-debt companies that can take on leverage, that can take those distressed assets off of somebody for a very cheap price, are going to be extremely well positioned to do so. And I think Public Storage is one of the very companies that can do that. As of right now, it has a financial debt to EBITDA ratio, or earnings before interest, taxes, depreciation, and amortization. For those of you who don't know the acronyms, they have a ratio of 2.26 times. That is, for real estate standards, very low. If we compare it to Extra Space Storage, one of its largest competitors, they have a debt to EBITDA ratio of 4.97 times. So more than two more turns of leverage that they're running relative to Public Storage.
I think that's I think that's important, Tyler, to the more recent performance. If you look at Public Storage's stock performance and total returns over the past few years, hasn't done as well as some of these competitors. It's even trailed the market a little bit. But I think a lot of investors, I don't want to say gave up on it, but they went chasing better returns in other places. And while they got those better returns in some of these other stocks, I agree with you that Public Storage, they're positioned to act when the market creates opportunity. As a REIT, because you rely on debt to fund, you need to be in a position with a strong balance sheet and quick access to capital when you're ready to make your next move.
It maybe not the best performer, but as of right now, earnings is not the best thing to discuss, but we'll use yield as a proxy. At a yield of 4.27% for its dividend right now, and a reliable history of growing that dividend over time. Over the past 10 years, it's grown at 10% annually. And actually, that's been accelerating. It's been 11% over the past 3 years. And it even grew its dividend by 37% in the prior year. So there is a track record of very generous dividend hikes and a reliable dividend that keeps on coming.
Tyler, I'm going to lean in a little bit different direction, definitely within the same idea of own forever businesses. And in this case, Brookfield Renewable, part of the Brookfield family of companies that are in big, heavy assets, alternative asset management business, and then some subsidiaries that actually operate a lot of these assets. In the case of Brookfield Renewable, started as hydroelectric dams, and over the past 6 or 7 years has accumulated a substantial portfolio of wind, solar transmission, and energy storage assets.
Hydroelectric in Latin America. Let's not sell ourselves short here. One thing Brookfield's been very good at is going places people don't want to go. And when you're buying hydroelectric dams in Colombia, people are like, "Are you crazy?" But they've made it work.
Yeah, it was viewed as an extremely risky investment when the company did it. The reality is it's been incredibly lucrative. Like Tyler said, they bought at really low costs. They've have a history of that, of accumulating assets that are sometimes distressed, or buying good assets from distressed companies is probably a better way to put it. And you look at the total portfolio now, 33,000 megawatts, or 33 gigawatts of total operating capacity. They have something like 100 gigawatts in their pipeline, and close to 30 of that, I think 27 of that, is likely to be coming online in the next several years. So it's extremely high growth in this industry. And because they are really good at originating and making timely investments across the cycle of demand, and then signing long-term contracts, power purchase agreements on the output of these assets, 20-year plus contracts with escalators built in for inflation, foreign exchange deals when they denominate deals in local currencies, a lot of things they do that are really smart that make this a wonderful own forever business. I want to talk about the dividend. Generally, the dividend has a pretty good track record of dividend growth. Even what looks like a cut in 2020 was the result of a corporate action that created Brookfield Renewable Corporation when they spun that out. So the total dividends awarded when that spin out's included have really consistently grown even from that period that looks like a cut. One of the things that's really attractive to me, because there has been some downside volatility with the stock over the past year or so, because of rising interest rates and expectations that would hurt the business, is the dividend does continue to go up. Using that, Tyler, as kind of a proxy, 5.5% yield is really good because it's a high yield for investors, but not so high as to be a headwind for a company like Brookfield Renewable, because they do issue stock to raise capital as part of their strategy in addition to debt. So overall, they're really well structured in their ability to raise capital. We talked about that with Public Storage. It's a similar story, that they have really good access to capital to move quickly when opportunities present themselves. Shareholders that have held this business over the long term have been very well rewarded, and I expect that's likely to continue too. Myself, I'm certainly going to continue holding my Brookfield Renewable shares, hopefully for forever, because that means I'll live forever. Isn't that how it works, Tyler?